It's status live. There we go. We are now live. Well, hi everyone. Welcome to the session. I'm Amanda West. Today we're going to be talking about how to ace your impact investment pitch. And we want to give you some tricks on the trade on how to master the lingo for impact investors and present your impact case to them. I'm from Mercy Corps Ventures. We are the impact investing division of the global development organization, Mercy Corps. We're early stage impact investors, and FinTech has been one of our core investment pillars since the beginning, so 5 years ago. And we recently started a new initiative called FinX, which is a $10 million initiative to really double down on what we're doing in FinTech. So not only to make more investments in the space, but also to help companies inside and outside of our portfolio pilot their products and services and refine them to reach vulnerable populations. Before I got involved in Mercy Corps Ventures, I was also an entrepreneur in the clean energy field and founded and scaled a company in that space for 5 years before moving over to the investment side of the table. Today, I'm joined with my colleague at Mercy Corps Ventures, Dan. And Dan, I'll let you introduce yourself.
Yeah, excellent. Pleasure to be on this session. My name's Daniel Boulaq. I'm a principal at Mercy Corps Ventures on our investment side. I have about a decade of experience in financial services. Started my career in traditional financial services on Wall Street, and have spent the last 7 years focused on impact investing in emerging markets, everywhere from Peru and Mexico to East and West Africa, and a bit in Asia, with a focus across a range of sectors, including agriculture, energy, and financial inclusion in fintech. So really excited to be able to share with you all here some of our experiences and learnings in terms of best practices in impact investing. And yeah, I think we have a few slides, and we'll kind of make this a sort of a little bit of sharing some of our learnings, but want to keep this as interactive as possible. So welcome anyone who has any questions to feel free to drop them into the question box. We'll pause it a few times to address any questions and leave some time at the end as well.
Yeah, definitely. Please feel free to interrupt. We want to make this session as useful as possible to everyone. So great. We'll dive in with our first bit about the language that VCs and impact investors use. So Dan, I'll turn it over to you.
Great. Yeah, so we just wanted to start to sort of set the stage by outlining kind of at a high level, some of the terminology that you may hear. And oftentimes, I think for entrepreneurs that aren't familiar with impact investing and impact investors, there's a lot of terminology that you'll hear that doesn't really resonate with you, and it may not be familiar. And so we kind of just wanted to set the stage with a couple examples. Are cases where oftentimes what we've observed is traditional commercially oriented venture capital firms and impact investors really tend to be looking at the same types of things, trying to understand sort of what is the market opportunity, what is a business's value proposition, what is the user experience, and how sticky a product or service can be, and ultimately how to measure all of those things. But they'll use different terms to talk about the same concepts. So, a couple examples that we wanted to share here. First is, when talking about a market, venture capital firms, they'll often talk about sort of the size of the market. What is sort of an attractive, large, untapped market opportunity? Impact investors tend to look at the market as well, but a common way that impact investors will speak about the market is talking about the underserved market. So, in both cases, it's looking at where's their opportunity to grow the market, but looking at it with a slightly different terminology. So, a simple example, like looking at Nigeria, where about a little less than 2/3 of the population in Nigeria is banked, but there's about 80% of the population has mobile phone penetration. A VC can look at that and say, well, there's a huge untapped market potential because roughly 20% of the population has the ability to be banked with phones, but isn't. Whereas an impact investor may look at that same 20% gap and say, this is a tremendous underserved market opportunity that's actually addressable, because not only is a significant segment of this population unbanked, but they could be banked because they have the technology and the tools to be able to do so. Similarly, a common term is trying to understand for any investor, what is a business's value proposition and what is the value proposition for their customers. VCs will talk about that a lot. Impact investors will talk about it as well. But really, impact at the end of the day is trying to understand sort of what your customer cares about. How do you serve that segment, and why is what you're providing something that's needed? So really, you can think of customer value proposition as the impact that you're having on that customer. And then, in terms of reporting, there's a lot of similarities in terms of the types of reporting that a VC is going to look for and that an impact investor is going to look for. There may be different terminology from time to time. Investors will expect businesses to have strong, management information systems, to have to be able to provide reliable dashboards around KPIs. Impact investors have a whole range of different types of frameworks that they use for evaluating impact and for looking at impact. But ultimately, sort of really strong, sound businesses tend to have these tools well integrated, and such that an impact investor, let's say, that's focused on how many people you're reaching and how sticky your customers are, is going to be looking at similar metrics as those which drive your profitability and your commercial viability. And then lastly, just to highlight a couple at the bottom here, number 4 and 5, there are cases where there may be slightly different things that investors are looking at, whether they're taking a commercial lens or an impact lens, but ultimately they're still getting at the same concept. So a commercial investor is going to talk a lot about sort of the competitive differentiation of a business. Impact investors tend to look with a similar lens, but around sort of the additionality of a company, what that company brings that drives not just a positive outcome for their customers, but a more positive outcome than alternatives that exist in the market. And then both investors look at returns. Common just to highlight a couple terms that are kind of analogous across the VC and the impact space. Looking at things like internal rate of return or multiple on money invested. Impact investors have similar terminology. There's a whole range of different ways of measuring returns, but a couple to highlight here are social return on investment, and TPG Rise, which is an impact investor that developed a new sort of way of measuring impact, developed something called the impact multiple on money that looks at the sort of economic gains of impact of the impact of their investment as a ratio relative to the amount of capital that they invested. So yeah, kind of lastly, before really diving into this, is we wanted to also outline sort of, we're going to be talking a bit in generalities around impact investors, but not all impact investors are the same. And it is really important, just like it's important for an edtech entrepreneur who's trying to raise capital, to understand the type of investor that they're raising from. That edtech entrepreneur is not going to go reach out to a private equity infrastructure investor to raise their seed round, because there's just total misalignment. We often see that there are businesses that are looking for a certain type of capital. They think there's an impact story around what they're doing, but they may be approaching the wrong type of investor, the wrong type of impact investor. And so we kind of looked at this on sort of 2 axes. One is understanding sort of how important is impact to that investor. So in the first sort of matrix, the key question really here is trying to understand sort of how important is impact to the investor. On the sort of far side, towards commerciality, there's investors that are really purely finance first. They're not really interested at all in impact. If there is impact, it may be a positive story to tell, but that's not really a decision-making factor of their investments or of their investors behind them. To think of an example of an investor like this, you could say, for instance, the Vision Fund from SoftBank is an investor that's purely commercially oriented in terms of their investment approach. And then on the far extreme side is you have purely philanthropic investors that are making grants to businesses with the sole hope of trying to drive impact. An example of that would be USAID. The U.S. Development Agency has a initiative called Development Innovation Ventures, which is specifically focused on providing grants to businesses that they think can have outsized impact. Another example that's maybe a little bit closer to home for those of us in the fintech space is the Catalyst Fund that's backed by the Bill and Melinda Gates Foundation. They work with a lot of early stage fintech businesses, and they provide grants to those businesses because they think there's a tremendous promise for them to deliver outsized return on impact, if not return on capital. Where most impact investors sit is really somewhere in the middle. And so you see sort of the Mercy Corps Ventures logo there on the impact first side. Most impact investors will be somewhere in the middle. And so the kind of gradations there don't matter as much, but to think of there are investors that are looking for, in some cases, impact is a core component of what they're investing for, and they're willing to sacrifice some return in order to generate that impact. In other cases, it may be they're not willing to make any sacrifices, but as long as the impact meets a minimum threshold, they're willing to make an investment that they believe is market rate. A lot of the early stage impact investors tend to be sort of somewhere in that interim stage. So looking at, for instance, Flourish Ventures, the spin out from Omidyar Network, Axion Venture Lab, and ourselves, I would say, are investors that are quite focused on impact. In some cases, are willing to make some exceptions from a finance perspective, but are looking to generate returns from our investments as well. An investor that maybe is a little bit outside that scope you could look at would be the Global Innovation Fund, which is an investor that also looks to make market rate returns on their investments, but is willing, where they see opportunities to deliver sort of really high impact, to be concessional in their capital. And so that basically means willing to accept a lower financial return in exchange for a higher impact return. So again, sort of understanding where your investor sits along that spectrum is important. Also understanding, regardless of where they sit along that spectrum, what kind of impact they're really focused on is important. So I'm not going to go through all of these categories, but just as any business may have a number of different ways that they're measuring the metrics that drive their growth. Investors will have different ways on the impact side of evaluating what kind of impact they want to look for. A couple examples here. You have investors that tend to be more micro in the way they focus on impact. And so, but what I mean by this is they're looking at sort of who is the individual person that's being impacted and how does this solution change their lives. These types of investors in fintech, financial inclusion, they're going to tend to be very focused on understanding the user journey and understanding how the solution improves the journey for that user. So does it save time? Does it save money on fees? Does it increase their trust in this financial system? And how do all of those benefits actually accrue to a user in terms of improving their overall way of life? On the flip side, there are investors that tend to be much more sort of macro and high level. And so those investors are going to tend to much more often look at things like, how do we improve the overall resiliency of the financial system? How can increasing the amount of transparency or increasing the efficiency of a system allow that system to be more productive, to lead to greater economic prosperity across the economy, and to lead to reductions in inequality? And so these investors maybe are going to look less at the individual impact on an individual user, and look more at sort of, what does economic literature say about the impact of transparency on reducing issues with doing business in a given market, and how does that overall lead to GDP growth, which leads to benefits that accrue across the population. Lastly, I just kind of wanted to end by giving a couple tips. These aren't by any means comprehensive, but a couple ideas of how you can think about sort of identifying where an investor sits along these two continuums. And frankly, a lot of these things are helpful for understanding where an impact investor sits along these continuums, but are things that are really useful for understanding as you're approaching any investor, trying to figure out where do they sit along the continuum and what's the best way to position a pitch to any investor. So the first thing is, looking at the website of investors is kind of quite obvious. Understanding sort of and seeing sort of how do they position themselves. And I think oftentimes images is just a really simple way to get a grasp of that. So, for an impact investor that's very focused on, let's say, financial inclusion for low-income populations, you're going to tend to see in their reports, in their website, the images that they show are going to be images that tend to look more like, people using analog phones, focused on sort of more rural populations or more underserved populations. A fintech investor, maybe their website's going to look, that has more of a commercial orientation. Maybe their website's going to look more like what you'd expect sort of to see out of a, Silicon Valley VC fund, or is going to look more like the way the website of a large commercial bank or a large investment bank on Wall Street would look. Right. Another thing is, again, just sort of focusing on the terms. So when you hear terms like ESG, socially responsible, sustainable, those are going to tend to be investors that have a little bit less of a direct focus on deep impact, and maybe are more focused on sort of overall good business practices. Does a business focus on diversity? Does a business have, sound governance practices, so there's not excessive control in one person's hand? Do they, generally have good ways of managing any environmental risks that they take? Whereas on the flip side, if you see impact specifically called out and discussed on the website, if you see terms like concessionality, subsidization, that's going to imply that it's an investor that's willing to make sort of concessions in order to drive for greater impact. A really simple thing, I think, in the space that we're talking about here, which is in fintech, is just specifically the way investors talk about their investment themes. So more impact-oriented investors will use the term financial inclusion much more frequently when they're talking about their sort of fintech theme, whereas commercially oriented investors are going to much more frequently talk about fintech as the investment sector that they're focused on. And then lastly, I would say just generally, it's always good practice to sort of look at as much information as you can get about an investor. So looking at their portfolio, what do their portfolio companies look like? Who's funding the investor? That can tell you a lot about the type of investor that it is. Looking at materials that they've published, if you want to understand how they think about impact, is it an investor that has an impact report that's public? How does that impact report talk about their impact, and how do they measure their impact? And then always the easiest thing to do and the best thing is to just kind of get a sense of who are the people that are involved. So who's on the team? What are their backgrounds? Talking to an entrepreneur that's taken investment from that investor, if you have the ability to do so, is a great way to understand sort of how that investor thinks about impact. And given that impact investing does tend to take oftentimes longer than traditional investing, because there's additional amount of analysis that goes into the due diligence, it's really valuable if you're approaching impact investors to speak to entrepreneurs that have worked with that investor, that can tell you sort of what the process is, how excruciating is the process, how long does it take, what are you getting into if you engage in that conversation beforehand.
Dan, that's super great advice to talk to other entrepreneurs that are in that portfolio. Ashley's also asking on the chat about what you've seen as impact priorities for impact investors as they relate to the SDGs. Are you really seeing impact investors aligned to the SDGs or not right now?
Yeah, it's a good question. I think we're seeing investors across the entire spectrum aligning to SDGs. It's just a common framework, and so that's why we have now not just impact investors, but again, investors kind of across the spectrum focused on SDGs, from public equities and mutual funds to large investment banks to impact investors. Impact investors will take different approaches. Some sort of again are sort of fine linking their investment themes or their specific portfolio companies to SDGs. Others, that's sort of like a base starting point, and they like to get a lot more specific. So yeah, it's really going to vary business to business and the investment sort of thesis from one investor to another.
Okay, great, Dan. Let's move on, and I think in this next section about common impacting questions impact investors ask, we can pull in some examples to answer Margaret's question about ingredients of the worst pitch ever, because I think a lot of it relates to the answers we've heard to these questions. So I'll let you dive in there. Thanks.
Yeah, absolutely. So, right, again, we're not going to be able to go through what is every single question that an investor is going to ask you. And naturally, that's going to vary, as we just discussed, investor to investor, and, business to business. There's a different type of question you ask to a business that's got a B2B fintech solution versus a B2C solution or a B2B2C solution. An insurtech business is naturally going to have different types of questions that an investor is going to ask versus a remittance company. That being said, we kind of wanted to break down a few broad categories of where we see investors, focus when they're looking at the impact component of their due diligence, and thought it would be helpful to kind of break it down into these four categories, looking at sort of first the beneficiary, second the market gap, third the evidence around the impact, and lastly on the business plan. And I guess I would say, sort of at a high level, the best responses that we get around from entrepreneurs are always the entrepreneurs that have a strong understanding of how we think about impact, that show an understanding of the types of investments that we've made in our portfolio, and that can speak to the way they think about their businesses and their impact in a way that aligns to us. I guess not to give, maybe like call out anyone in particular, but types of pitches that tend to fall on deaf ears for an impact investor are honestly going to be the same types of things that would fall on deaf ears for any investor. I've had times where entrepreneurs come in to pitch and they don't have an understanding of who we are, and they start pitching for an investment size that's way outside of our scope, or they start pitching for something. For instance, at Mercy Corp Ventures, we invest in 4 different investment segments. They start pitching to us something that's way outside of that. Let's say something in healthcare, or something in renewable energy, which is profoundly interesting and important, but it's just not something that we're specifically focused on. And then I think the other thing that we'll kind of get to more with some of the examples as I'll run through is, entrepreneurs, I think, oftentimes have this balance where you're trying to sell your business and align it to what an investor is looking for. But if it comes across as being too transparent, that you're just trying to kind of to tick some boxes, that also doesn't necessarily come across well. And so, I think most shrewd investors, they're looking for entrepreneurs that recognize that they have limitations and gaps, but that have a clear view of sort of where they are, where they're going, and where what they'd like to achieve. So, making widespread claims of we're reaching the entire 20% of, going back to that example, we're reaching the entire 20% of the population that has mobile phones but isn't banked, and we're able to solve that, probably isn't realistic. Having sort of a realistic view of what you can achieve and how you're going about it. So yeah, just to kind of dive in, then I'm not going to go through all of these, but I'm going to really just highlight a couple. The first is so looking at the beneficiary, I think it's really important to when you're talking about sort of who you're impacting, to be able to explain to an investor clearly sort of what that profile of that person is, and to show that you understand your user and why your solution serves that user. Most impact investors are going to look quite closely at sort of the theory of change, the impact mechanism, and how well you actually understand that mechanism, to be able to assess to what extent they believe that the business is going to be able to achieve that impact. And the best businesses, when they're pitching around this component, they're very specific. They show a strong understanding of the overall market, but the segments that they're specifically focused on and which ones they're not. They can be quantified in terms of talking about sort of what the impact is. So not just talking about something like financial wellness or financial happiness or savings, but being able to quantify what those savings are. And they're realistic, as kind of we've been talking about. They're not saying that their smartphone app is going to be able to solve financial inclusion for a segment of the population that doesn't have a smartphone. So they're realistic about who they're serving. the flip side, those that are really general, not particularly quantified, and that purport a solution that doesn't really meet the needs of the users that they're saying that they're going to serve, tend to be less effective. So, looking at the remittance market, an example of the kind of thing that wouldn't be particularly compelling on this first theme would be saying something like, we enable the 10 million Nigerians who receive remittances abroad to be able to accept them with lower fees via smartphone app. On the flip side, something that would be sort of much more compelling is to sort of say something like, our solution helps informal workers that have families abroad to be able to receive remittances 10 times faster and with 50% lower fees than the competing fintech companies in the market. And this actually saves those users 1 month of time waiting for remittances and $100 per year through this process, which our survey research or our initial indications indicate that allows those users to be able to use those savings for the following items. So really an understanding sort of the quantity of the magnitude of the impact and the sort of end result of the impact. On the market gap, to kind of walk through this briefly, I think it's important, again, to sort of, just as we were talking about, to be honest about the problem and where you're additional to that problem. Oftentimes, we'll see startups, whether it's in fintech or other sectors, talk about how they're better than the traditional sort of traditional system. But the real comparison should be, how are you better than the other startup next to you that's doing something similar? So like, and again, using the remittance space, a lot of startups will compare themselves to Western Union. But in a lot of markets, there's a whole lot of other alternatives besides Western Union. There's, TransferWise, there's local fintechs, there's international fintechs that are trying to solve cross-border payments. And if you're only looking at sort of the old system or the incumbents, you're not necessarily making a kind of a compelling case around your additionality. The evidence piece is also really important. And I just kind of wanted to highlight here, there's a couple different ways to think about the evidence of your impact. First is thinking about what often a lot of folks call sort of the evidence in. So this is like the secondary research. What is the, if you have a theory that remittances is going to improve people's lives, what is the research? Because you're not the first one testing that theory. So what does outside research show about the way remittances improve people's lives in India or in Latin America or in other markets in Africa? And why do you believe that based on that research, you should be able to generate that similar impact? That's kind of what I'm calling here evidence in. On the second side, there's sort of a component which is more internally focusing and looking at, okay, so the research says that this is the case, but internally, what evidence are you seeing that you guys are actually generating that impact? And so looking at sort of what metrics do you use to measure impact? What are your own KPIs for impact? And how closely do they match sort of that external literature are both very important. And I think they're especially important for early stage impact investors because no matter what early traction you've gotten, if you only have a few months of traction, let's say, it's going to be pretty difficult to extrapolate your experience from a handful of users to tens of millions of users. And so having some external research to back that up is critical. On the flip side, if you have really strong external research, but again, you're early stage and maybe you don't have fully your impact suite of metrics yet, you don't have enough results to be able to determine whether a credit scoring mechanism actually reduces defaults because it's just too early in the process. Being able to ground your theory in something that's been externally validated is critical. And then lastly, just to touch on the business plan. Wanted to highlight here as well that that I think another issue that entrepreneurs sometimes fall into is thinking about their business as having to have a trade-off between impact and financial returns. And while there are some investors that are okay with that, most impact investors are looking for business models that are strengthened, where the profits are strengthened by the impact as opposed to the other way around. And so, here again, sort of thinking about how you can embed impact into your business model is something that's quite critical.
Great, thanks, Dan. And Ashley, I think we'll be able to get to your other questions in this half of the presentation. So, Dan, really spoke to some like really great things, like questions you need to be prepared to answer, questions that you might want to answer in your pitch deck. Some things I want to get into is like, how should you be showing impact in your data room? Like you're ready to raise, you've got your data room all together. If you want to raise to impact investors, having a subset of your data room, a specific folder dedicated to impact is really, really helpful. So here are a few things, like documents that we look for in any investment that we're going to make, and that we think, are helpful to prepare. So the first three I'm going to get into examples of, so I won't cover those, the route to impact or your theory of change, what does your impact KPI dashboard look like, and what kind of impact risk analysis have you done? So we'll dive into those a little bit. Some other things that you could include are any kind of secondary reports that you use to validate the impact of your business model, similar to what Dan was talking about. Like lots of people have done lots of studies. If you're drawing on any of those studies to evidence pieces of what you're doing, having that really clear to the impact investor and having that report easily available in your folder is super helpful. Similarly, any of your own reports that you're producing, like whether they're annual reports or impact reports, it's just really helpful to see like, how are you telling the story of your company? Like we want to understand what's important to you about your company and the change that you're making in the world. Other things are like customer surveys, or even like your customer intake process through your app. Like, what questions are you asking, and at what point in the like customer journey are you asking those questions? And then if you're doing any follow-up surveys, what results have you seen from that? So, just being transparent about what are those questions, when are they asked, what results are you seeing? And then lastly, like just your customer stories. And, I've seen a lot of customer stories, and not all customer stories are that great. So I just kind of broke it down in like 4 components that I usually look for in a customer story. So one is like, who is the person? How can you describe them? Like, age, gender, education level, unbanked status. I mean, just anything like how, what kind of describers are important for you and your business. What's their status quo as it relates to your product or service? Have they never had a bank account before? Have they, only sent remittances via Western Union? What was happening before? And then how did they get introduced to your product, and how did they use your product? How long have they been using it? How much do they use it? And then what were the results of that? So I'm going to dive into like the first 3 pretty quickly. I know we're getting tight on time, but basically like impact investors are like, they want to know how you think about how does your business achieve impact. And a really easy way to articulate that to them is to come up with your own route to impact or your theory of change. And a theory of change is pretty easy to put together. It has 4 main components to it. So the first component is the problem statement. And like Dan said, like, while it's great to like talk about, what's the global problem, you've really got to like drill down beyond that to, what's the problem in the market you're trying to solve, and, exactly your problem statement needs to match your activities. So you need to get really specific here and rely on secondary research to help validate your problem statement. The next component is like your impact logic. So the impact logic is just like the activities that you do. So, you create a platform, you recruit people to the platform, you provide loans to people, or you facilitate remittances, or, whatever you do, like those are all your activities, and they're going to lead to some kind of outputs. So people are taking loans, for example, people are sending remittances, those are all outputs that are happening directly from your activities. And then from those outputs, people are experiencing some kind of outcome. So, it's whether it's like, time savings, money savings, something like that, like there's some kind of outcomes there. And then in the long term, like those outcomes are going to build into an impact in a person's life. So you just kind of like lay that out so an investor can follow, like, here's the logic of my business to get to this longer term impact that I've been talking about. And then underneath each of those, you can put, your evidence and like KPIs. So like, how are you actually validating that those things are happening? And this gets more difficult to do as you move to the right, as you're going from like outputs to outcomes to longer term impact, because longer term impact is harder to track. So at the beginning, you may not even have any KPIs. in that category, and that's fine. But you can like use that to have a conversation with investors about like how you plan to measure that over time, and get some ideas out on the table. The last part of the route to impact is like assumptions that you're making. So in any business, you're making assumptions about your customers, about your business model, about the market, about a lot of things, and like each step in this process. And so it's really important to articulate like what are those assumptions, and then make sure that you have KPIs to validate or track on what's happening with each one of those assumptions. And basically, I think we've all seen businesses that have gone down the road. They're making like key assumptions about their customers. They're not validating them, and then somehow they get a year or 2 years down the line and they realize that it's not working. They don't actually have product market fit, and they need to like go back to the beginning again. And so doing this type of exercise can really help you like pull out those key assumptions and like really help strengthen your business model overall. The next thing is like your KPI dashboard. So I'm sure you all have a KPI dashboard already. For impact investors, it's really helpful to see like a subset of your dashboard specifically for the metrics like you deem your impact metrics. And there's going to be a ton of overlap with your standard operational KPIs and your impact KPIs. So some of the common metrics that fintech impact investors are looking for, all these are going to sound really familiar to you guys. So it's number of client transactions, it's the description of your target stakeholder group. So, the who, the socioeconomic status, the gender, those types of things. Other ones are about client individuals that are provided new access. So, somebody who's already had a bank account, for example, and you're just giving them a different type of bank account, that's different than somebody who was unbanked previously. And so, impact investors are really looking for what products and services can serve this, unbanked population, or serve, even more vulnerable populations that don't already have access to these types of services. Another one is about, active client individuals. So, it's not just about the number of clients in your network, it's like how many of them are actually active. I'm sure everyone's already tracking that. Percent change in client transactions is really coming up as like a depth of impact metric. Impact investors want to see that, you have a client and they're using your product and service, and then they start using it more and more. Like you're capturing more and more of their, financial services needs. And they're not, maybe sending a remittance on your platform once and then sending it on another platform other times. You're capturing like 100% of their remittance business. And then lastly are a couple of metrics around like appropriate product design for underserved populations. And these are things like interest rate, default rate, transaction fees. Impact investors are going to be looking to see that these are designed in a way that's not, harmful to underserved populations. That you're not kind of taking advantage with a really high interest rate, for example. And then, Ashley, I think your question was on impact risk, if I'm remembering correctly. So, all impact investors recognize that there is substantial risk in impact and impact coming to fruition. So some of the impacts that we would be expecting entrepreneurs to be able to speak to are listed on this slide. A lot of this is really coming around to like appropriate product design and like how do you integrate your potential customers into your product design process. So that's where we would see a lot of like stakeholder participation risk or a lot of drop-off risk. So even though people have access to new financial products, they might not be using them because they aren't designed to really meet their needs. And so we're looking for things like that. We're also looking for like the contribution of like how your product or service is like positioned in the market. So, I think we've all seen a lot of oversaturation of some types of products in the market, like, Kenya, definitely oversaturation of mobile loan products. And so, if you are, maybe the 60th mobile loan product in Kenya, like how is your product really different? And like, how are you not contributing to the client over indebtedness problem that's already emerging in that market? And Ashley, I'm just looking back at your question on the risk. Let's see. Yeah, about best or worst case scenarios for impact. I think a lot of that comes down to like what are your sales projections as well. You know, like what Dan was saying, like we want to see that like impact is baked into your business model, and like as your business grows and scales, your impact is also growing and scaling. And so, you know, for anything like that, we would expect to see, you know, your different scenarios. So like your best case, your worst case scenario, and then, you know, really seeing that like route to impact, and like seeing all those assumptions you're making, and like how are you going to validate those assumptions. And so all of that is going to give us more peace of mind that like you are going to you know, figure out the impact risks that are going to come up over time, and like you're measuring and managing those risks as tightly as you're managing any, you know, operational risk to your business. Okay, great. I'll just move on really quick. This last piece, you know, I think the impact management project is probably one of the best things that's happened to impact and like how to think about and talk about impact. And, you know, I think everyone can appreciate like impact investing is still a really nascent field. And when I was raising from impact investors back in 2011, they really had no idea what they were doing. It was just a kind of a free-for-all. Everyone was trying to like figure it out. And now there actually is some global consensus out there about how to like think about impact. And the impact management project is, you know, one of those great tools that you can use to tell your impact story that, you know, lots of investors are behind, you know, foundations are behind, you know, Barclays, Bank of America, BlackRock, you know, all types of global players are like really behind this. So how you would break it down, I'd like to do this mapping of in each of these 4 dimensions. This is an example from a company that has created like an Uber for moto taxis in Mali, and they do asset financing of the motorbikes for their drivers. And this is really kind of like a mix of like a fintech, you know, decent work play. So the impact this company is striving for is really this high level, like decent work. Like they want to create opportunities for underskilled youth to have, you know, safe, well-paid work. So what you're seeing here are some like broad KPIs that like track to each of these dimensions in the impact management project. And then some of the results and like key messages that you can write off of that. So like Dan was saying, you know, it's really important to like back up your impact messages with data. And the impact management project helps you figure out like what are the compelling impact messages that I can be telling off of the KPIs that I've pulled from my theory of change. So the who for this company, you know, like I said, they're really focused on underskilled youth. So we talk about, you know, drivers on their platform that have less than a high school degree, or that were previously unemployed before they started working for the company. And then they also have an interesting play around female drivers. So we track like the percentage of their drivers that are female, and, you know, how that creates an opportunity in a typically male-dominated field. On the how much side, the impact management project breaks it down into scale, depth, and duration, which I think is really helpful framing for like how much impact is happening. So, you know, a lot of companies really stop at the scale piece. You know, they're just talking about their number of customers. And the impact management project, you know, is really like, let's go a level deeper, you know, like let's look at the depth of impact. And for this company, you know, that's a really great opportunity to talk about the average earnings for drivers, the number of drivers who own their bikes, and the accident stats. Because again, we're trying to create like safe, decent work for people. You know, if you're thinking about you know, a remittance company, for example, like if their depth of impact, you know, would be around, you know, savings in transaction fees or savings in time, you know, for example. And then, you know, lastly is about like contribution. So this dimension of impact is like, you know, how is what you're doing better than the status quo? And, you know, sometimes the status quo is like the Western Union, you know, it is the like institutional player out there, but sometimes it's not. Sometimes it's the black market. Sometimes it's, you know, other startups in the field. Sometimes it's something else. So like, what are you benchmarking yourself against? Like, what is that status quo that you are improving? And then what kind of measures are you making that improvement on? So anyway, I can highly recommend the Impact Management Project. Their website's really great about dissecting all these different dimensions and how you might use them to talk about your impact. And then lastly, we just wanted to leave you guys with some additional advice from other members of our team. So we won't get into those, but I think Dan talked a lot about a lot of these. I'll just highlight, like, really number 5, describe your personal connection to the problem you're trying to solve. That's super important when you're pitching what you're doing. Like, we would just really want to hear, like, why are you the best person to solve that? Like, how are you uniquely positioned for this? And then lots of other great advice too. We'll make this presentation available to everyone. But yeah, like Ashley said, we are recording. So yeah, we just wanted to give a few minutes to open it up to any live questions or any questions that we might have missed in the chat that we didn't see.
Amanda, I'm just seeing, so maybe just to address one question from Ashley here. She's asking, in the same way that investors might look for a business to provide, base case, downside, and upside scenarios, do investors typically look at that for impact? And I would say so I think several of the questions come back to this common theme that, the most compelling impact case is one that's just embedded in the case of the business itself, where you have to spend a lot of time kind of creating 2 separate narratives or pulling pieces together is actually probably a sign that you're going about it the wrong way, because fundamentally the business case should be very much aligned to the impact case. Yeah, I mean, there may be certain things that an impact investor would be interested in that a VC investors, that a commercial investor is not going to be. But if you have an upside, downside, and base case financial forecast, and as part of the build up to that, you have number of customers and the number of active customers, the frequency of activity for those customers, that should really be sufficient. Now, if part of assessing what you think the actual impact is based on some other variables, I would say you probably don't need to go out and say, let's look at a whole range of different outcomes for those additional variables. Simply saying, sort of, here's our financial forecast. Here are some of the key assumptions around how we translate the revenue per user or the savings per user into a tangible impact for that end user. And here's why we think that's a reasonable approach to take. Should be sufficient. I would, so just like investors will tell a lot of businesses, don't go trying to build a financial model for your IPO when you're raising your Series A. Keep it simple. I would say the same thing is true for impact. And then I
agree, and I've really only seen nonprofit social enterprises take that approach. When they're getting a grant, kind of like a best effort grant, and then they kind of like tell like high, medium, and low impact. But that's like a really specific use case, and definitely like outside of what I've seen for-profit social enterprises do, and what I've seen impact investors ask for.
Then another question, just wanted to tackle quickly. There's a question about sort of what's the average ticket size for impact investing. Truthfully, I mean, impact investing runs the full gamut. So you have seed stage investors and pre-seed investors. You even have angel investors that are incorporating impact. I think someone made a comment that impact investing sounds like an awakened VC. I mean, those of us that are real practitioners in this space think that the impact investing will win when everyone is doing impact investing. So you have angel investors that are focused on impact investing. On the other end of the spectrum, you have larger investors like TPG Rise that I mentioned earlier, like KKR. You have larger investors that are getting into impact investing on the private equity side. I would say for sort of fintech investing in Africa, a lot of the fintech, the financial inclusion impact investors are going to be anywhere from $100,000 tickets up to $5 million. But you'll find investors that can go lower. Several of which we've already mentioned, and you'll find definitely investors that can go higher. And then Amanda, maybe I just wanted to pass over to one other to you, which we have a couple questions here around how do you sort of balance the cost of like measuring impact? And got an interesting question, like, are there any systems, software, frameworks that can particularly be helpful, recognizing that early stage businesses can can't do everything. So how do you balance sort of the right balance?
Yeah, that's a really great question, and I'm glad somebody asked it, because when I was an entrepreneur and investors were talking to me about impact, and they really wanted me to get into what's my rigorous measurement strategy. Am I going to do a randomized controlled trial? All of these things, and I was like, no, like what money do you think I have to like be able to do this? Like, I'm a bootstrap startup who is like operating a high volume, low margin business. And what I didn't realize at the time was that we were already doing surveys of our customers. So like we were like thought about like what are our existing customer touch points. Okay, great. What is the best time for us to actually ask questions to our customers about how they're using our product, which is like clean cook stoves and solar lights. So are you using this? Is the product working for you? Like, what kind of feedback do you have? How likely are you to recommend this product to a friend? Like all of those typical like customer questions. We were already doing that. And in my head, like that was just good business practice. That was just good, product design and like getting customer feedback and incorporating that into your business. That wasn't impact. But that really is like, what I know now is like, any surveys that you're doing of your customers, like those can be like lean, mean surveys. They use your, typical customer touch points. They're already using your current systems. Like that's not something that costs a lot to do. So, you can put together a 10-question survey for your customers that you do every quarter to a random sample, for example. And that can be your impact assessment approach for a really long time in your business, like for years. And impact investors like can be really satisfied with that. So you don't have to make it complicated. That's something you can use in Google Forms, and just track that over time. Sorry, Dan, what was the other part of the question? I think I missed part of software.
Yeah, someone was asking if there's any software systems. I think you started to mention with Google Forms, but
yeah, there definitely are systems for that. I would say like with any system, you don't want to build up a lot of tech debt until you really need to like figure out what you need before you like go down the road of engaging with the system. So there's systems like SOPACT, like SOPACT. It's like a system like all about like how to like measure your impact, but you might as well like start with Google Forms and Google Sheets and track it that way until you really know like what might be useful for you over time.
Excellent. I know we're kind of well past, but maybe just to tackle one last question that was raised, which I think is an interesting one, is how do impact investors measure impact? So how do you compare different projects in terms of their impact? And the truth is, each investor has different ways of doing it. There's no quantitative science or accepted best practice of how to do that. And so understanding sort of how one investor thinks about it doesn't necessarily give you insights into how another does. I'll give a couple examples. There are some investors that look at things sort of like consistently across the globe. So the fact that the minimum wage or the poverty line in one country is going to be higher than it is in another country. Let's say, for us, we invest in Latin America and in Africa. The poverty levels in a country like Colombia are just going to be different than they are in a country like Kenya. Some investors will say, well, poverty is poverty, and so we're not going to make a qualm about whether an impacted person that increases their income 50% in Colombia is more or less impacted than someone that increases their income by 50% in Kenya, just because they're starting at a different base. So they'll kind of contextualize the impact. Then there are other investors that will sort of say, no, we look at everything consistently across the whole board, and we'll sort of unify everything in terms of our investing. When I was at Global Innovation Fund previously, we had sort of a metric of looking at populations living under less than $5 a day as sort of the threshold of impact that we would look at. And so inevitably that meant that we would actually be doing less projects in Latin America because it was harder to find those businesses, given that there's a different poverty level. Some investors also will be much more quantitative in terms of how they kind of rate the impact. And so investors that do that, even though there are limitations with any sort of algorithm or framework for scoring, can sort of say, okay, based on the way we scored impact over here, this business got a score of a 80, and this business got a score of a 75. So that means that we will focus more on this business. Whereas others look at sort of a whole range of different factors, including portfolio diversification, sort of the overall theory of change that they're looking to have, conviction in the entrepreneur and the entrepreneur's ability, if they're successful here, to catalyze sort of follow-on impact in the future, and sort of the synergies between a given business and other portfolio companies or other value chains that the investor's focused on. So yeah, unfortunately, some investors have more of a precise way of doing it, and some have a little bit more of a nuanced way. I don't think there's necessarily one is better than the other, but it is a valid question, and I think it's something that there's also room for more sort of standardization within impact investing to think through.
Yeah, and Dan, just to add, at Mercy Corps Ventures, like we are always having conversations about the trade-offs and the different dimensions of impact. So like the reach, the breadth, and the depth of impact. So the reach, like who is being served by this, the breadth, like how many people are being served, and the depth is how much. And so, like we really recognize that like some business models that, reach, for example, like smallholder farmers, are really well designed like for that underserved population. May not be able to reach large numbers of smallholder farmers, but will reach, who they do in a really, really deep way. And so we'll have conversations as a team of like, does that trade-off of like, breadth of impact and depth of impact make sense for us? And do we see this business model being replicable in, other geographies, by other people? And, it's really important to help validate this as an impact model in and of itself. So, I think lots of other investors are having similar type conversations, and, like recognizing that it's hard to have, all of those things happening all the time, and that, companies are like building into impact and greater impact over time as well. And, that could be, we're really early stage investors. So we're often willing to, have those conversations early and like, go on that journey with companies. Great. Well, everyone, thank you so much for your time today. It was really great chatting impact and pitching to impact investors with you. Like I said, this presentation recording will be available. This is our contact information in case anyone wants to reach out with some specific questions, or if you think you might be a fit for our fund. Of course, we want to hear from you. So thanks, everyone. Have a great rest of the Africa Fintech Summit.
Bye, everyone. Thanks for joining.